As 2025 draws to a close, the global crude oil market leaves behind an important message. This was not a year of shock, it was a year of strategy. Oil prices did not collapse and they did not surge. Instead, 2025 became a year defined by policy discipline, controlled supply, and forward-looking market expectations. Brent crude opened the year close to $80 per barrel. As the months progressed, prices gradually softened, slipping into the high 60s by mid-year. A brief rebound around June and July reflected geopolitical tensions and short-term sentiment. But by the fourth quarter, prices eased again, settling into the low to mid-$60 range as the market began pricing expectations for 2026. On average, crude traded around $70 per barrel in 2025, lower than early optimism, but stable enough to avoid systemic disruption. The 2025 price story can be summarized clearly: policy over panic. First, OPEC Plus supply management dominated market direction. The gradual unwinding of voluntary production cuts signaled the return of additional barrels, reshaping price expectations throughout the year. Second, geopolitics remained influential but temporary. While conflicts and tensions created short-term support, none were strong enough to reverse the broader downward trend. Third, global demand remained steady but cautious. Economic growth slowed in key regions, energy efficiency improved, and gas and renewables continued to cap upside momentum. Let's look at the key drivers of crude oil price movements in 2025 with examples. 1. Russia-Ukraine war, geopolitical risk premium, not supply collapse. The Russia-Ukraine war remained a persistent background driver of oil prices throughout 2025. 2. OPEC Plus supply policy and the gradual unwinding of cuts. The most decisive driver of oil prices in 2025 was OPEC Plus policy. 3. Middle East tensions, short-term spikes, no sustained rally. Tensions in the Middle East, including risks around shipping routes and regional conflicts. 4. Slower global economic growth and demand caution. On the demand side, 2025 was characterized by caution rather than collapse. 5. Strategic petroleum reserves and market buffers. Governments entered 2025 with clearer playbooks: strategic petroleum reserves, diversified supply sources, and coordinated policy. Impacts. For OPEC countries, the year was a balancing act, supporting prices without surrendering market share. In the United States, lower crude prices helped moderate inflationary pressure, while shale producers prioritized capital discipline over aggressive growth. In the United Kingdom, 2025 reinforced the importance of fiscal stabilizers. Windfall mechanisms remained in place, while investment focus increasingly shifted toward carbon capture, hydrogen, and industrial decarbonization. For Nigeria, the impact was more direct. With oil revenues central to public finance, 2025 underscored the need for conservative benchmarks, improved production efficiency, and accelerated gas monetization ahead of 2026. Looking to 2026, as the year closed, crude prices increasingly reflected expectations of surplus risk rather than scarcity. The lesson for governments and industry is clear: volatility is no longer an exception, it is the baseline. Planning, resilience, and diversification now matter more than chasing high price assumptions. Closing. 2025 was not a year of oil price drama. It was a year of oil price discipline. And as we move into 2026, the market is sending one clear signal. Strategy matters more than speculation. This is Rig to Pump, turning crude realities into energy intelligence.